The Money Show. Personal finance.
Are you gathering any data on me, Warren Ingram? Because if you are, I don't know. I'm frightened.
I've got something to sell you. Yeah.
Anyway, listen, let's go on to things that we can control. Got a great email from somebody this week who said, don't mention my name. So John says, I am a CA and 29 years of age. I want to invest smartly and don't think my financial advisor is doing me justice. I earn 60,000 Rand a month. Oh, John, you're my friend. And after deductions, my net is 35,000 Rand. Of the net, I invest 7,300 Rand in an RA and another nearly 3,000 Rand in tax-free savings account. So of that 35,000, about a third is going into retirement savings and tax-free savings, which is good. I've got 2 paid-up cars. Why do you need 2? I have an apartment, which I'm renting. John's doing very well. I pay an extra 2,500 Rand a month to accelerate my bond payments, and I earn a rental of 5,000 Rand a month from the apartment. Anyway, this is all very nice and very detailed, but I'd like to get ahead and make the right financial decisions. I have no faith in funds, which I think I mean shares or unit trusts. Thus, I was wondering if you could guide me, and I want you, Warren, to be my financial guru, and I want to be your astute learner.
I'll do my best.
Guru.
So let's just go through the 3 steps to financial freedom. Step 1, you need to be obviously debt free. I mean, so in his situation, he's got his mortgage, but he's paying a heck of a lot of extra money into that mortgage. But I think so if we say debt free, and then you need an emergency fund. And an emergency fund to me is something where it's accessible money. It's not a long-term investment that can cover your expenses when life happens. So typically around 3 to 6 months worth of your expenses. So if you're spending 10,000 Rand a month, you need somewhere between 30 to 60,000 Rand in an emergency fund. So for John, he's paying extra money into his mortgage every month, which means that's money he can access if he needs it in an emergency. So I think he's covered his emergency fund very nicely.
Good. Yeah.
Step 2 is, to me then, is your retirement fund contributions. So I worked out that he's contributing about 12.2% of his salary before tax. And the law allows you to do quite a bit more than that.
37 and a half or something.
27 and a half.
27 and a half.
So to me, he should bump that contribution up to 16,500 Rand per month, and so that he maximizes his retirement fund contribution. My comment there will be just make sure that the retirement annuity that he's going to invest in is good, low cost, that he doesn't get locked into contracts. He can move it if it's not done, if it's not doing or being managed correctly, or he doesn't understand what it is. So to me, that's the important point around that retirement fund contribution. But he should definitely escalate.
But he says he doesn't have faith in funds. And if you've got no faith in funds, if you don't have faith in shares and unit trusts, retirement annuities are essentially unit trusts that you can only access when you from the age of 55 onwards. Now you're telling him to put more money into something he doesn't trust.
Yeah, but if you hadn't alerted him to it, he would have just done it. Now you've just told him, so now he's going to ignore us on that step.
No. Thanks. But I mean, he's a smart guy, is John. So you need to convince him as to why it's a good idea, not what he must do, but why is it a good idea to do this, Warren?
I mean, in my view, if we look at the unit trust industry. In South Africa, internationally, and the stock market, you need to understand that many millions of people over the last 117 or probably even longer than that, 120 years, have done very well from investing in shares and then more recently out of unit trusts and then exchange traded funds. And so to me, to have no faith in those, I think is a mistake, because they are nowadays, especially unit trusts and exchange traded funds, they are extremely transparent. You can see exactly what the fees are that you're paying, how your money is invested, what the potential risks are, etc. So to me, I think that John's doing himself a disservice here. I think he really should be considering them, and if he's going to go into unit trust RA, I think he's going to do incredibly well out of that. So I would say he really needs to do it, actually.
But by upping his retirement annuity contributions, does he keep the tax-free savings account going as well? Because that's also a nice little sweetener.
He does. And at the moment, he's contributing $2,750 a month, which is the maximum he's allowed to do if he's going to do that for the whole year. You're only allowed to do $33,000 a year. What I would say, there's a lot of people make the mistake of only assuming that a tax-free savings account is a bank account, which it's not. It can also invest in shares and exchange-traded funds and unit trusts. And we don't know John's age, but I assume he did tell us he's 29. So he's young. So he needs to invest in something in a tax-free savings that's got a lot of potential to grow. So either listed property or shares, or at least a balanced fund. And I know he doesn't like funds, but hopefully he's gonna listen to my arguments and take them seriously.
Okay, I mean, and when you look at, I wish I'd been this 29-year-old. I really do. Earning this much money and
I wish I was earning that much now.
And this responsible, frankly, and this in control.
Yeah, absolutely. And I think he's doing incredibly well already. What I would encourage him to do with the rest of the money, if he's got any left after all of this, would be to keep actually paying off that bond even faster. So I think that's the last point is we're sitting in an environment where interest rates are still, they're not low. I mean, and most likely at his age, the banks are probably charging him very close to 10.5% interest. And so to me, the faster you can pay that off, the better, because I don't think stock markets are going to give you a guarantee. Well, they're never going to give you a guaranteed return. And if we look at the current environment for the next few years, it would be amazing to get sort of 10 or 13% a year from shares. So I think rather take the guarantee, which is pay off your bond.
Right. A couple of other questions coming through, Warren, which I'd like to get to. And Dandoleni in Kempton Park, great question for Warren. What is it?
Yeah, my question is it good to have good evening, everyone. Sorry.
That's all right.
Is it good to have more than one retirement annuity?
Do you have more than one retirement annuity in Dandoleni?
Yes, but what I'm saying is it a good idea to have more than one?
Okay. Lovely question. Thank you. Is it a good idea to have more than one retirement annuity, Warren?
I generally don't like to have more than one investment vehicle. So I don't like to have more than one tax-free savings or more than one retirement annuity. And my reasoning is that, especially in the modern age with unit trust platforms that provide you these vehicles, they tend to give you lower fees the larger your investments get with them. So I would rather try and bulk up my assets to benefit from low administration costs. You can always choose 2 or 3 different underlying unit trusts, but I always like to try and get economies of scale and size. So I'm not convinced that it's a great idea. And
what's the difference between having more than one retirement annuity and having 3 funds part of one retirement annuity?
So a retirement annuity is a bit like a glass. It's what you put in the glass that really matters. So the fact that you've got 4 glasses and you put a little bit of water into all 4, you've actually got the same thing ultimately. It's still just it's still just water. Whereas if you mix the different ingredients in that water, you can go from water to a cocktail, as an example. So the RA is just that glass, and it's what you put in that really matters. And there you could say, okay, let's put in 3 different funds, that create a cocktail instead of just some plain old water.
And depending on the platform you use, you could hypothetically have an Old Mutual general equity unit trust. You could then put somebody else's property fund into it, somebody else's bond fund, and if you felt that banks were going to be the best, you could put somebody else's bank fund into this retirement annuity basket.
Absolutely. And the only thing you'll just need to know there is that you will need to comply with a law called Regulation 28, which says basically, you can have a maximum of 75% in shares and 25% overseas, but nothing stopping you mixing and matching your funds to get to that asset mix, if you like, and nothing compels you to keep 75% in shares. So if you really don't like risk, or you potentially a bit long in the tooth, you can definitely have a lot less than 75% in shares if you feel like it.
Who are you calling? Okay, anyway. And Dandoleni, hopefully that helps. Warren Ingram from Galileo Capital.